Good morning and welcome to Fast Market. It's January 14th, a Monday. I'm Tom White, joined on set by Kevin Hincks, co-host of Fast Market, and also by Scott Bauer, CEO of the Prosper Trading Academy. Welcome, guys.
Did you almost
morning.
my name?
Yeah, there was a little stutter there.
Senior moment, wasn't it? Right in front of us.
Well, it said January 14th on the teleprompter, and I'm
Okay, my name's not January 14th.
Yeah, I know. I almost messed it up. I recovered. All right,
nice
guys.
recovery, Maverick.
So we've got futures down a little bit, about 0.3, 0.4% in the S&P 500, guys. It was
about halfway home
we
here.
We had a lot of data out of China that kind of
Yeah.
dragged us down when futures opened last night. And when that data came out, and it was trade data, biggest deficit that we've seen with China as far as the U.S. goes. But what do you take away from those numbers, Kevin, as far as our equity market here domestically?
You know, there's so many things to pick today.
Yeah.
You can pretty much make a case any way you want today. There's so much data out there. I watched, because I'm sick and I've got a problem. I watched the futures open last night at 5 o'clock.
So did
They're
I.
down about 8.5
Yeah,
is
so
where
did
they
I.
opened. And then they just drifted all night. There was just nothing to give them any legs. And then we get to this morning, they were pretty much near the lows when the markets open, and then Citigroup, what a recovery.
Yeah.
It's crazy. And it gets to my point. What a year. What a difference a year makes, isn't it?
Yeah.
With these banks' earnings. And it kind of throws some uncertainty into these banks. You know, if they meet expectations, then maybe some of these banks are going to rally here because they're overdone.
Yeah, I mean, if you look at it, expectations going into last year, and I think to hit on Kevin's point here, expectations going into financials results last January were pretty positive, but they sold off on pretty good numbers, Scott. Today, we get pretty mediocre numbers out of Citigroup, and the stock reverses from turning down 1% in the pre-market. Now it's positive, nearly $2.
3%.
Yeah, 3%. I mean, is it this sector's been oversold? Is that it?
Well, that's what it sure seems like today. Some bottom feeders coming in, especially when you read the report. And one thing we've talked a lot about, and something that I've been advocating over the last month or so, is we're probably going to see some decent trading revenues out of these big banks because of the volatility we had. Well, that was not the case
Only
with
on the
Citi.
equity.
Only on the equity, not the fixed income.
Right, fixed income.
Not the fixed income side. That, really, to me, threw a wrench into it, yet shrugged it off, and here we are, a couple bucks higher now after being lower pre-market.
But I think some of the data that they released, Tom, like the book value for the fourth quarter and the tangible book value, came out all considerably higher than where the stock's trading.
A lot higher, right.
Yeah, $75 on the book value for the fourth quarter read, and the tangible book, $63.
Yeah, and
so interesting take there. That may have just giving people a little bit of perspective.
They kind of blame the volatile markets and the credit spreads widening out a little bit as far as this report goes for Citigroup, but that fixed income trading did fall 21%.
And that was the miss in revenue. It was almost all fixed income.
It was all
if you
fixed
look at the
income.
number.
Yeah, and if you look at their expenses, they were starting to cut their expenses. I think they expected about a 1% pullback on expenses. It was 4%. So that actually helped their bottom line a little bit. Maybe there's some short covering in here too. A little bit.
Oh, yeah, because a lot of these banks have been heavy for quite some time. If you look at the charts on them, if you put this all together, not really surprising that people are starting to pick some bottoms here and trade them.
Well, let's go to the Thinkorswim trading platform, because we did some example trades in Citigroup real quick. And I think we did a diagonal. We did a stock replacement in there where we bought the March 55 calls. We sold the January 60 calls. So this move higher is actually helping us. We paid $3.60 debit for that particular trade.
Looks like it's traded about $4.30 right now.
$4.30. So it's doing well, and we've got about 4 days until expiration on the 18th for those 60 calls. So if we can get that Citigroup shares to continue to rally, we'll get more for those rolls.
Kind of a nice little place we're in right now because you've got choices, right? And it all has to do with what do you think going forward? For not only Citigroup, but the banks in general.
Yeah, take your profit if you think it's going to turn down.
Exactly. If you're not sure about the banks, remember, you're going to get a slew of banks the next 2.5 days. If you think, well, this is a nice little number I got here, close it. There's your first choice always.
Right.
Close that trade, reevaluate, start again. But we're just below the short strike of $60.
Yeah.
If we get another good number from the banks tomorrow, it could continue here
Right.
and go towards 60, which is a max winner on this trade.
Yeah, so I think that as far as trade management goes, Scott, is that what you look at, like based on the duration? Because you got 2 months until the March is expires. So you got 2 months in this position. You got that ability to roll. And I think it's based on what you're comfortable with. If you think Citigroup's going to turn down and the banks aren't going to do well, then sell the heck out of this thing, right?
So you can never go wrong taking your profits.
Right.
If you're still bullish, though, I would actually look to roll the short strike here because, yes, we're approaching where we want it to go, 60, but there's only 30 cents left in that short option. If I'm still bullish, I'm looking to roll that 60 strike of this week out another week, another 2 weeks, and get some more premium while I'm still keeping my long bias on the trade.
Same strike or
Maybe
different
even
strike? And that depends how
it all depends where
how
the
fervently
premium is.
you're bullish on this
Exactly.
game, right?
Yeah, and so we've got the actual roll value right now for just a weekly roll, a 7-day roll, buying our short Jan 18s to the 25th, about 24 cents. But like Scott said, you could go out another week or two.
Not a great price level.
No.
Since this option's trading 30 cents,
Yeah.
you're only rolling it for a quarter.
Remember that though, the
Patience could be key
bank
here.
stocks on the options front usually have pretty low premiums
They
do.
outside of that.
good-
Very
It's
much
good
so.
call.
What is the 2 week roll?
Kevin will go ahead and look
take
up
a
that.
there.
Go down the Feb 1.
50-ish.
43.
Yeah, 43. Yeah.
Not big numbers, but then Tom's right. That is indicative of these financials.
Yeah.
And think about this, guys. If you're not comfortable with all that risk, the $3.60 that you have on, this whittles away at that
Or-
on a slow basis.
Or the obvious, close half.
Yeah.
Right?
Do
Hope
that
you're
too.
wrong. In the famous words of SLS, close half and hope you're wrong.
Yep, that's true. That's a great way to look at it. A
Yeah.
great trade management skill on
And,
that.
and you're also you're working from a position of power with
Yep.
this position right now. So like you said, lots of options there.
Yep. All right, guys. Let's get into the week ahead, right?
Yep.
We don't have any economic data today, so let's get into what we're looking at going into this week. So, of course, we've got earnings season starting. We had Citi today. Got J.P. Morgan tomorrow.
And Wells Fargo tomorrow.
Delta
Another big one.
tomorrow, and we're going to talk about all those. Wells Fargo, United Airlines tomorrow after the close. Then we've got Bank of America, Goldman Sachs, CSX on Wednesday after the close. See, I like to look at those as a good barometer for the overall market. So CSX on Wednesday afternoons in my radar. And then the big one, Netflix on Thursday after the close. That stock's had a really nice rebound from those lows we saw in December. Is it getting ahead of itself? But we're going to talk about that. Is there a specific name that you're looking at here, Scott?
Delta, actually.
Yeah.
There's been so much negative news over the last week here. It's coming down to, technically a really, really significant area around that 44, 45 area. There's some big-time support there. I'm of the belief that there's so much negativity out there that's
Got
already
downgraded again today.
Right, already almost like a pre-announcement. I kind of like it here.
Which they actually did last week.
They did.
Came out and lowered guidance just a tad bit. And we're going to get into Delta in a little bit because if you look at the way that
Look
they've
at the
traded,
3-year weekly.
They're
I mean,
basic-
these are some
they're actually
That's what I'm looking at.
right there.
Right
Yeah.
in there.
they're actually the pricing of the airlines right now, as far as forward-looking earnings, they're pricing in a recession.
Yeah.
Basically, if you look at a lot of the fundamentals.
or a lot more capacity, one or
Right.
the other, right? I mean, some way they're either adding seats or taking away
They
customers.
did add 5.4% on the capacity side.
That'll do it.
Yeah.
The capacity word is a bad word. in the
Yeah,
airline
that's
industry.
Yeah. So we're going to focus on that. Kevin, what name are you looking at as far as the earnings front goes this week?
I want to see the banks. I want to see these banks because they're so beat up. I think that the trading action on Citi this morning was fascinating.
Yeah.
Just the difference between last year and this year, the expectations, the actual earnings, and the first one I'm going to look at Goldman.
Goldman. Down, it was
Goldman,
down, it
they've
was
hit
down
that stock
over
so hard.
Over 30% from January 1st of last year.
Yeah.
So this thing's had a rough
I mean, the one-year
ride.
chart on Goldman, that is.
I think it was the biggest loser in the S&P, right?
Yeah.
I always want the one. Good companies that are beaten up always get my attention for some reason. Sometimes to my detriment, but I do like good names that are beat up.
And you got to watch these banks, and Citigroup was a perfect example. Short squeezes that come into play because the sentiment's been so negative on these names, and they've been sold and downgraded. And, it just seems like there's no light for these. But then you get a mediocre report out of Citigroup, and stock's up 3%.
I tell you, my pitch for a new segment on this show, head-scratching trade of the day. And
Citigroup.
Citi is absolutely today's winner.
All right, guys, let's move over to economic data this week. Now, government shutdown in its 4th week might take a toll on some of the numbers coming out. The ones that I was focused on, more PPI tomorrow, retail sales Wednesday.
Not coming out, by the way.
Not coming out.
And a government shutdown, no retail sales.
Yep, unless they come to some conclusion by Wednesday. Got Beige Book on Wednesday. Housing starts, housing market index. Industrial production is the one that I'm looking at, guys.
That's Friday, right?
That's Friday, but we've also got Empire State Manufacturing tomorrow. We've got Philly Fed later this week. So there's going to be some manufacturing data which has been soft. Scott, what are you looking at as far as economic data goes this week as a big mover?
I think it's going to be a lot of noise. Noise meaning that unless we get a massive outlying number in any of these reports, it's all going to be explained away by the shutdown.
Right.
So I think you almost have to look beyond that and really focus in on earnings this week. Maybe housing starts, to me, is going to be one to look at a little bit.
See if it rebounds due to those rates coming down.
Exactly. See what kind of correlation there is between mortgage refis to the rates. But I think it's a lot of noise this week.
Yeah, and I think you wonder if the market's going to overlook a lot of this data too, based on maybe the choppy inputs on it.
Well, the question that people are going to have is, can you trust the data?
Yeah,
right.
You know what I mean? If you get some outlier number, is that because of the shutdown?
Right.
That's why. I mean, here's the big 3 names that are not coming out this week because of the government shutdown. Obviously, you mentioned retail sales, construction spending, and business inventories.
Yeah.
Those 3 are not coming out.
Yeah.
There's a couple other ones.
And everybody wants to see those retail sales.
Especially the retail sales data.
Because look at what happened last week with Macy's and Kohl's getting hammered a little bit. Target, based on the first outlooks of the holiday shopping season. So, but let's turn to one the retailers that's actually doing pretty well today, Kevin.
Lululemon.
Came out with some good report here today as far as Lulu goes. And, they said same-store sales going to increase low double digits.
Tom White, we said on this show right before Christmas, and what did we say? Macy's was a mess. And Lululemon, the line was out the door and it was organized.
Right.
And look at the news that's come out since then.
I know.
Trust our data, Tom.
Yeah, same-store sales, they view them up mid to high teens on a constant dollar basis. They raised their EPS for Q4 also, which is coming up. But we don't have earnings in there for a while. But the stock is up 8.5% today, Kevin.
And this stock, remember, it was beat up pretty well, too. It came down from the mid-160s and really the end of September, beginning of October, and it got down into the teens.
Yeah, and there was a lot of analysts out there saying, hey, it's a buy here because their margins are so expansive. They've got good coverage in that high-end retailing space. But Kevin, trade management on the Lulu position.
You've got a position.
We bought a diagonal, a stock replacement diagonal. We paid $8.55 on this diagonal, where we bought the March 130 calls. And we sold
just
the January
3 lot.
8. Yep.
That's just it. Doesn't take a lot, does it?
Yep. So we sold the Jan 140 calls that expire this Friday. So it's a 2-month trade, but we paid $8.55 for it. Why don't we go ahead and take a look at what that thing is trading right now?
Right now, it's trading about $12.40. Yeah, $12.30.
Okay. So the question to you first, Scott: close it or keep it open? Take some of it off? What would you do here?
Well, what's your sentiment moving forward? I mean,
exactly.
This one is a really nice winner. You got about 50% winner in this in just a few weeks here. So what is your goal moving forward? Was this your goal for the stock to move towards the short strike 140 at this expiration? If it was, and that was kind of your upside move, then you've hit it, and maybe in this environment, you take some off, you take half off. I would actually like to look to roll to a higher strike and collect some additional premium.
And for those people that say, well, I don't want to do that for a debit, hold on. You can roll both and get a net credit out of it. Right? That's the great thing about it.
If you believe that it's going to continue to grind up a little higher, that's another way to do it.
And the thing is, you can take profit out of this
Right.
by rolling both strikes
Reduce your
up.
risk
If you
and
turn
take
this
some
into the
profit.
135, 145,
Yeah.
you can do that for a credit.
Yep.
And take bank
Absolutely.
money, keep the same position on going forward
Yeah.
with less risk.
Yeah, I like that, but I like closing maybe one or two of these. We have a 3-lot in our example trade, so maybe taking one or two of those off and then maybe rolling up is a way to play it. But you know what? This thing worked
Just
out.
for learning purposes, here's what we'll do. I'll compromise. We'll close 2,
Okay.
okay?
That's over 50% gain on that one.
Right, because, I mean, guess what? We are in, you know what business we're in.
We're in the moving business,
We're in
Kevin.
the moving business.
That's
now,
right.
the other
Not
one,
storage.
here's what we can do. We can roll, here's the way you can do this. You can roll this one, but then we're going to roll to out and then to another strike.
Out and up.
Yeah. So, but look at, you're going to have to pay a debit for
Okay.
that. Now, that right there causes people to pause. It doesn't cause me to pause.
Right.
I think it's okay as long as you think it's going
Now,
up.
if it's a regular calendar, rolling for a debit doesn't make sense. But this is a diagonal where we get
Right.
to roll the other one also for a
Exactly.
credit to offset that.
Remember, it was about $1.90 we paid.
Okay.
Or we had to pay
The roll there.
Right,
Yeah.
the roll. So now, all you got to do, you're not really rolling this. You're just moving it down. You're basically selling the vertical spread to move that strike down from the 130 to the or up to the 135.
135.
So watch. So let's. Here we go. We got
Got
one
a one
fill.
lot, yeah.
And then you just do this. You sell that,
And now
you
you're going
buy
to
it-
get 3 change.
and you
right?
buy the 135. And now look at. That's about $1.60 credit
Yeah.
you've taken in,
Right.
and you've lowered your
Totally.
net debit on this spread.
You might actually get out of you might be out of all risk on this particular trade because you locked in a gain of nearly
With the gains of the
50%
other one, right.
Of the other one. Yeah, so that's a great exercise on how to manage these positions that you put on that are working out pretty quickly. I mean, typically we don't see quick moves like that, but they
Right.
worked out for us on both of those.
There you go. Now look what we have on. Now that we're out of the 130, 140 into the 130, 135, and we've taken money off the table.
Right? That's a great way to look at it. Now that's also with that belief that, hey,
There are commissions
in a good
involved
spot.
in that,
Yep.
but still you've done, you've more than paid for that with profit.
Now you can sleep at night for the most part. Right. All right, guys. Let's move over to Delta Airlines. They've got earnings tomorrow morning, and this stock has been hit pretty good since the start of 2018, down 14%. Even with, I mean, we talk about it nonstop, guys, when we talk about the airlines. People are flying. Business travel is pretty robust.
When's the last time you got on a plane and the seat next to you was empty?
About a year ago.
I don't
Yeah,
remember. I don't remember the last time.
Hasn't happened.
Right.
Mine was about a year ago, and that guy got upgraded to first class, so I sat there with the seat open next to me. But that being said, the stock's down about 2.37%. On that downgrade today, the analyst noted that the flight indicator data analysis from Bank of America suggested a deceleration in domestic PRASM.
Presm. Don't you know what that
PRASM.
is?
Come on,
Revenue.
everybody knows that.
It's a
Revenue per assigned seat mile.
per seat mile,
Yeah.
right. But they've got different names. Each airline's got a different name. Weak ISM survey, they said, declining CEO confidence, airline pricing growth off of highs. Those are the headwinds, guys. I'm
But
I'm
here's the
stating
thing.
what the
This is what an analyst will say on the bottom.
Yep.
Right?
Yeah.
Absolutely.
Sorry, I've seen this movie before. This
We've
is
all seen it.
exactly what they'll do on the lows.
Yep.
I mean, and to come out the day before earnings,
Yeah.
too, to do this. I mean, that's,
do you think part of it is that downgrade or that mid-quarter update that they gave last week, where they said, "Hey, we're lowering our expectations for revenue from 3.5% to 3%," and they said they didn't gain anything from the lower fuel prices, which just blows my mind. How tight the margins are in this business, where oil can fall from $76 a barrel down to the low 40s, and you're not taking advantage of lower fuel prices. That just blows my mind.
well, you know what's really interesting in the airline space, and I'm not sure about Delta, but American does not hedge their fuel.
Oh, okay.
They're one of the major carriers that does not hedge their fuel. I'm not sure about Delta Airlines, but you're right, Tom. I mean, how do you not take advantage of
And
that?
they have
How
a
does that-
refinery. Remember, they bought
do.
that
They have their own-
refinery years
exactly.
ago. I mean, so, that should be even better for them.
You would think.
I don't know.
They've basically taken one of the middleman steps out of the process.
Right.
If you have your own refinery.
I was
go ahead.
going to say, my trader spidey senses tell me that you want to buy into these downgrades.
Right.
Too many, too strong stocks. You know, look at where it was.
You got to look at guidance on this stock, guys, because if Delta comes out and says they see a weakening economy in 2019, not only here domestically, because we're already seeing it overseas, that is going to be the caveat to this report, I think. If they guide any softness or show any concerns, that's my take.
Yeah, I mean, wait, I would agree with you if the stock hasn't just sold off 25%, right? I would agree with you.
Exactly.
And everything you're saying, if this was November 30th and the stock was 61.
Yep.
But it's not, it's 47.
Yeah. If you look at this one compared to American Airlines and United Airlines, the premium is, as far as what Delta trades at, 7.7 times forward-looking earnings is a premium to United, a little bit of a premium to American Airlines.
9 PE.
Yeah, so that's a concern looking forward.
Now,
but let's look at some strategies. Go
Even
ahead.
though we're going to talk about this and we like this, everyone should brace themselves because the airlines are volatile players. They always have been. Remember? I mean, I remember United Airlines in the late 80s and how crazy these. So just remember, if you're going to trade airlines, get ready for volatility because these, you can look by how these trade. They move and they move in one direction.
But
So just
Yep.
full disclosure.
And they all go, the correlation's really high between all of them because of the business that they're in. Current IV percentile rank, only 48% because of that big spike that we saw
From
in
last week.
December. Yeah.
And also the news of last week.
Right.
Yeah,
So
because why is it down? Because look where it went to on their lows when it spiked lower.
that was the low of the market, by the way, on the 24th,
Yep.
that half-day session that we had on Xmas Eve. But let's take a look at what else are you looking at in here? Because puts are out trading calls today by about
Not
1.2
big,
to
now,
1.
Similar to the discussion we were having on financials, not big premiums in the options.
$2 expected move either way, plus or minus.
And that's what,
5% move.
Yeah.
Right.
Yeah. So there's not big premiums in these options. The unbalanced butterfly, a little different, only about 85 cents is what it lined up, and that was a $1 one. So maybe if you went a little further on the one balanced butterfly, let's see. If we went 47, 45, 43, maybe we can get a little more premium on this.
$2 wide on each vertical there, creating that butterfly. And
See, they're just not lining up for anything.
yeah, there's not a lot of premium to collect on those. And with the multiple number of contracts that you do there, that starts to really
You're just not. I'd like
deteriorate that credit.
Normally, our minimum is about $1. You want to see, and you're just not getting it.
Let's go look at. I want to, if you took that bias to the upside, right?
Yes. Which I certainly wouldn't take one to the downside.
Yeah. Let's go ahead and sell the 46.5, and maybe sell the 49 up here. So you've got higher volatility in here, 55% in the January 18th, according to the platform, down to 41% down below, right? So if we sold, let's get this up here. If we sold the 49 calls and the 46.5 puts, you're collecting roughly about $1.26 credit, right? But you want to protect those, right? You can't just sell those naked options. So what if you go down here to the 44.5 and create a double diagonal, and then the 49s, you got to buy the 51. So it's $2 wide on each side, skewed a little bit to the upside. You collect credit of roughly 68 cents, but let's go ahead and analyze this double diagonal that we bought. It's only 1 week wide. Let's go ahead and put that up, and I believe there's something else in there. Yeah, there we go. So here's the actual profit and loss of this particular trade, 68-cent credit. The ideal spot is between those break-evens of about $45 and just over $50. So that gives you some width without doing that iron condor, but you also get that ability to roll those short options to the next series. But this is a neutral type strategy. The bonus points are at the short strikes. Your thoughts on this one, Scott?
I like the setup. I would actually move the puts up a little bit to give us a little bit more delta, a little more bit more protection to the upside, and skew it that way. But I like this particular setup.
Yeah. And that's if you have that bullish sentiment where maybe they're going to beat, maybe even if it's bad like Citigroup or mediocre, maybe it can rally because it's been beat up so much. So that's a way to do it. And Kevin's going to go ahead and run through that.
I'll lower this put. What we're going to do is raise the put price. Is that what you meant, Scott? Right. We'll go, let's try 40. Where's stock trading?
47 or so.
Yeah.
All right. Let's go, maybe we'll do
47?
Yeah.
47, 45, 40,
Yeah.
something.
That's a way to look at it. And you'll collect a little more credit on that one,
Right.
too, by skewing the puts.
There. We'll do that and make it a 45.
Let's see what the price is.
Now we
78.
took in another dime and we turned this into a longer delta.
Yep. Longer delta, you get to positive time decay, which is great.
Right.
You're playing Vega a little bit because you're buying that longer term, the wings to protect what you. The thing I like about that is you get to roll those short strikes to the next series to reduce your risk, potentially increase profitability on that. So Kevin went ahead and put that in.
And I think it's really important to note that no matter what happens, whether the stock went to 0 or 100,
Yeah.
right? Regardless of the size of the move, you are completely still risk defined.
Oh, yeah.
Right? Regardless of the size of the move.
About $1.22 on that particular trade is your
exactly.
total
Which
risk.
basically, in essence, it allows you to be a little more aggressive if you have an opinion on it, because you know, worst case scenario, you're risk defined.
Right.
All right, guys. So Kevin went ahead and put that in. That does it for this segment. Scott's going to join us at the end of the show here. But coming up next, it's time for bank earnings. So we're going to face off with Ben Watson. He's going to take a look at the banks versus the S&P 500. Stay right here on the TD Ameritrade Network. Fast Market.